tired of paying your fair share? Discover how the ultra-rich use international regulations and complex offshore trusts, sometimes even before their children are born, to legally bypass paying taxes. Learn the 5 shocking strategies they're using to build wealth tax-free while you're left footing the bill. One common strategy involves using offshore accounts and shell companies. Think of it like this. Instead of keeping money directly in a bank account in your name, wealthy people might create a company in a country with low or no taxes. This company then holds the money. Because the money technically belongs to the company, and the company is based in a low-tax country, less tax is paid. It's all about using international regulations to their advantage. There are wealth preservation benefits and also inheritance benefits. These are only available to high net worth individuals due to costs to set up. Another popular method is investing in tax-advantaged assets. Real estate is a great example. By strategically using depreciation and write-offs, property owners can significantly reduce their taxable income. Private equity and hedge funds also offer various loopholes and strategies that allow wealthy investors to defer or eliminate capital gains taxes. These investments allow them to build wealth through tax minimization. Trusts and foundations are also frequently used. These are legal entities that hold assets for the benefit of someone else. Rich people might set up a trust for their children or grandchildren. By transferring assets into the trust, they can avoid estate taxes and potentially income taxes as well. Foundations can also be used for charitable donations, which provide further tax deductions while also supporting causes they believe in. This is effective estate planning and gifting strategies. Pass-through entities, such as LLCs and partnerships, offer another way to reduce taxes. The income from these businesses passes through to the owners, who then pay taxes on it at their individual rate. This can be lower than the corporate tax rate. Plus, these entities allow for various deductions and expenses that can further lower the taxable income. This is also known as profit shifting. That is only for high-income earners. Finally, wealthy individuals often exploit international tax treaties. These agreements between countries can help avoid double taxation. By carefully structuring their affairs to take advantage of these treaties, they can minimize their overall tax burden. They can also establish residency in countries with lower tax rates, reducing their tax obligations even further. This requires global mobility and residency planning. It's important to remember that these strategies are generally legal, but they raise questions about fairness and social justice. While the rich are using these methods to minimize their taxes, the average taxpayer is left to shoulder a larger portion of the tax burden. It also brings burden and reform. There is an ethical debate whether they have the obligations or duties to do so. While we've covered these 5 key strategies, many complex details remain unexplored. How are these strategies impacted by changing international regulations? What role do financial advisors and lawyers play in facilitating these tax avoidance schemes? What are the long-term consequences of such wealth concentration on society? These are important questions for further research and discussion. If you found this video informative, please like, share, and subscribe for more insightful content on wealth, finance, and taxation.